Welcome to The Explainer. Today, we're unpacking the story of a massive American industrial giant that is standing at a historic crossroads. We're looking at Union Pacific Corporation. Right now, this company is doing something of a high-wire act, balancing record-breaking financial results against the pursuit of an absolutely unprecedented, massive mega-merger that could literally reshape the entire North American supply chain. It's a fascinating dynamic. Now, before we jump into it, just a quick disclaimer. This explainer is strictly for educational and informational purposes, so this isn't financial advice. All your investment decisions should be made with a qualified professional. The information we're covering is based on publicly available sources as of August 2026. Market conditions do change, so, always do your own research.
Okay, let's dive right into this and take a look at our roadmap for today. We're going to hit 5 key areas. First, meet Union Pacific. Second, record financial results. Third, the $85 billion mega merger. Fourth, Wall Street's verdict. And finally, major risks ahead. So let's kick things off with Section 1. Meet Union Pacific, the industrial heavyweight.
Now, Union Pacific, trading under the ticker symbol UNP, is currently the single largest publicly traded railroad in North America. They're based out of Omaha, Nebraska, and they operate this incredibly vast network. We're talking over 30,000 miles of track, mostly covering the western two-thirds of the United States. It's really hard to overstate the sheer size and the staggering diversity of the freight this company moves. Agricultural products, coal, chemicals, automobiles, you name it, they ship it. Just last year, in 2025, they generated $25.4 billion in revenue. And with a market cap hovering right around $179 billion, they are a true heavyweight in the industrial sector. But here's the thing, 2026 has been anything but business as usual for this giant.
That brings us to Section 2. Record financial results, firing on all cylinders.
And this brilliantly illustrates exactly what I mean. On July 23, 2026, CEO Jim Vena announced what he called record financial results for the second quarter. They posted an adjusted diluted earnings per share of $3.41. That is up 13% year over year. They completely crushed Wall Street's expectations, which were sitting down around $3.19 to $3.24. And as you might expect, this massive beat really fired up the market, fueling a major stock rally, with shares jumping anywhere from 4% to 5.6% right after the announcement.
When you look at the broader metrics, you see that financial momentum everywhere. Operating revenue hit $6.9 billion. That's a really healthy 12% jump year over year. And that growth was driven by higher fuel surcharges, volume growth, and some serious core pricing gains. Net income climbed 6% to hit an even $2 billion. But I really want to draw your attention to that operating ratio at the bottom, 59.7%. As you know, for railroads, this is an absolutely critical efficiency metric. Even though higher fuel prices definitely added some pressure, the company still managed to pull off strong productivity gains to keep that ratio super lean. And because of this phenomenal performance, they actually went ahead and raised their full year 2026 outlook to high single-digit EPS growth.
But here is a fascinating, specific detail from that quarter that you just have to see. $91.1 million. That's the amount of extra fuel surcharges Union Pacific collected over what they actually paid for fuel in Q2. That single factor boosted their EPS by roughly 14 cents. This is a perfect textbook example of massive pricing power in action. They have the leverage to pass their costs right on to customers and then some.
All right, moving to Section 3. The $85 billion mega merger, a coast-to-coast ambition.
So, pivot with me for a second because we have to talk about the hurdle in the room. Union Pacific is aggressively pursuing an acquisition of Norfolk Southern. The stakes here are truly historic. If this goes through, it would create the very first coast-to-coast freight railroad in the United States. We're talking about combining into a seamless network of more than 50,000 miles of track spanning 43 states. As for where it currently stands, on August 18, 2026, the U.S. Surface Transportation Board, or STB, officially resumed its review of the merger after a pause. But listen, it's absolutely crucial to understand this. The STB explicitly stressed that resuming the review does not signal approval in any way. It's just a procedural step to get the ball rolling again. Now, what's really interesting about this timeline is just how incredibly long and drawn out this regulatory uncertainty is going to be. Looking at the schedule, they had to refile their work papers in August of 2026, but the final briefs aren't even due until May of 2027. And a final decision? Well, we shouldn't expect that until the second half of 2027 at the absolute earliest. That is a massive cloud of regulatory wait and see hanging over the stock for well over a year.
And during this massive wait, a fierce battle is playing out. There's some highly organized opposition to this deal. 6 different rail unions have pushed the STB to outright reject the application, and they're specifically warning about a repeat of the 1990s, when major rail mergers led to nearly 20% reductions in rail employment. Plus, you've got competitors like BNSF and CSX, along with shippers' organizations, urging dismissal because they fear a huge drop in competition. On the flip side, Union Pacific and Norfolk Southern are vehemently arguing that this merger will actually enhance competition and drastically strengthen the national supply chain. They even managed to get Canadian National to drop their opposition after striking a strategic agreement. So, lines are being drawn.
But despite all this intense friction, company leadership is showing some steadfast confidence. Case in point, earlier in the year, former President Trump expressed interest in the U.S. government potentially acquiring a stake in this massive merger. Well, Union Pacific CEO Jim Vena's response was incredibly blunt. He stated right on the record, "We do not need anybody's help to do this." They are entirely committed to pushing this through on their own operational merits.
Let's shift gears to Section 4, Wall Street's Verdict, Digesting the Crossroads.
Let's step back and see how the market is processing all this. So far this year, the stock has been on a total tear, widely outperforming the broader market with roughly a 29% gain year-to-date, trading right around the $300 mark. When we look at analyst consensus across roughly 24 analysts, it sits firmly at a moderate buy. While the absolute lowest bearish target is down at $245, the average price target sits around $331. That implies there's still roughly 9% to 14% upside from current levels. And we've seen major players like Citi, Wells Fargo, and Bank of America all maintaining buy ratings recently. So the crucial point is that while momentum is undeniably strong, there is a very real debate happening right now about valuation. On one hand, you have models like Guru Focus's GF Value warning that the stock is actually 15 to 20% overvalued right now compared to an estimated intrinsic value of $255. But counter to that, you have models like Simply Wall Street estimating the fair value is closer to $327, making the bullish case that it's actually 10% undervalued. It really all depends on how you weigh their current blockbuster earnings against that future merger uncertainty.
And income investors definitely have something to chew on here too. Union Pacific recently bumped its quarterly dividend to $1.42 per share. That's an annualized payout of $5.68, which gives you a fairly safe yield of about 1.9%. Their payout ratio is a very conservative 45%. That means they're retaining 55% of their earnings, which leaves plenty of capital room for reinvestment or, navigating those upcoming merger costs. Though it is worth noting, we have seen some net insider selling over the past quarter, which is always an interesting metric to keep an eye on.
Let's move into our final section. Section 5, Major Risks Ahead, What to Watch. Let's take all of this and see how it builds a picture of the specific challenges ahead, because this is far from a risk-free play. There are 5 distinct risk vectors here. First is obviously merger uncertainty. There is absolutely no guarantee the STB will approve this deal in late 2027. Second is fuel price volatility. Yes, we mentioned they managed it well recently, but their fuel expenses still jumped a whopping 63% in Q2. If those prices stay sky high, margins could eventually compress. Third is valuation. With the stock up 30% this year, a lot of the good news might already be baked into the price. Fourth, we have labor and regulatory hurdles, ranging from union contracts to wage inflation. And fifth, economic sensitivity. At the end of the day, railroads move the physical economy. If industrial production or trade slows down, Union Pacific's volumes are going to feel the hit.
Which leaves us with this final, massive question. Is the biggest rail merger in history on track or headed for a regulatory derailment? Union Pacific offers an incredibly compelling mix of strong baseline fundamentals, incredible pricing power, and a potential game-changing coast-to-coast expansion. But as we've seen, that all comes with a massive X factor of regulatory battles and serious valuation debates. How you weigh those operational highs against that deep uncertainty is ultimately going to define how you view this stock going forward. Thank you so much for joining me for this explainer. Keep learning, keep analyzing, and we'll see you in the next one.